Are you looking to dive into the world of long-term investing? Well, you're about to set sail on a fascinating voyage. The realm of long-term investing may seem complex, but with the right guidance it can become an exciting journey towards financial security. This video will serve as your compass, offering 10 invaluable tips for those of you starting out. These tips will help you navigate the turbulent waters of the stock market, and ultimately lead you to the treasure of sustained financial growth. So let's gear up to embark on a journey towards financial growth and security. Tip number 1. Understand your investment goals. As you embark on your investing journey, it's vital to first recognize what you're trying to achieve. This isn't just about making money, it's about understanding your personal financial goals and how investing can help you reach them. Are you saving for retirement, or perhaps for your child's education? Maybe you're aiming for financial independence, or simply looking to grow your wealth over time. Each of these goals may require a different approach to investing. For example, if you're saving for retirement that's decades away, you might be more inclined to invest in higher risk, higher return assets like stocks. But if you're saving for a short-term goal, you might prefer safer, lower return investments like bonds or money market funds. Understanding your investment goals also helps you determine how much risk you're comfortable taking on. If you're young and have a long investment timeline, you might be able to tolerate more risk in pursuit of higher returns. But if you're nearing retirement, you might prefer safer investments that protect your wealth. Remember, clear goals are the compass that leads to successful investing. Moving on to tip number 2, do your research. The world of investing is a complex ecosystem teeming with opportunities and pitfalls. To navigate these waters successfully, independent research is crucial. Don't just rely on stock tips from the grapevine. Instead, take the time to dive deep into the data behind the stocks you're interested in. Look at the company's financials, understand its business model, and study industry trends. Remember, you're not just buying a stock, you're buying a piece of a business. And the more you know about that business, the better equipped you'll be to make informed decisions. While this may sound time-consuming, it's worth it. Comprehensive research can help you identify opportunities that others may overlook, and avoid stocks that are not as promising as they appear. This approach not only increases your chances of long-term success, but also makes you a more confident and savvy investor. In the world of investing, knowledge truly is power. Tip number 3. Be realistic with expectations. The world of investing is not a rose garden where every stock blossoms into a tenfold earner. It's a tumultuous ocean where some ships sink while others sail smoothly. The harsh reality is not all stocks will bounce back after a decline. It's crucial to be realistic about poorly performing investments. Imagine buying a stock and it starts to decline. You might think, it's going to rebound, I just need to hold on a little longer. But sometimes a sinking stock is just that, a sinking stock. It's important to assess each situation individually, avoid falling into the trap of wishful thinking, and know when to cut your losses. The stock market doesn't grant wishes or follow our expectations. It follows its own rhythm, often swayed by a multitude of factors that are out of our control. So, adjust your expectations to align with reality. It's not about pessimism, it's about realism and making informed decisions based on facts, not hopes. Remember, investing is a marathon, not a sprint. It's about the long game, the steady growth, and the power of compound interest over time. So, be patient, be persistent, and above all, be realistic with your expectations. Tip number 4, keep an eye on the big picture. When it comes to investing, it's easy to get caught up in the day-to-day fluctuations of the market. But remember, investing is a marathon, not a sprint. Instead of focusing on short-term volatility, pay attention to the overall trajectory of your investment. Think of it this way, if you're on a cross-country road trip, you wouldn't turn back just because of a little traffic, right? In the same way, don't let minor bumps in the market deter you from your long-term investment journey. Stay focused on the end goal, and remember that the path to success isn't always a straight line. The best investors know how to keep their eyes on the horizon, weathering short-term storms for long-term gains. So, don't let the noise of the market distract you. Instead, keep your eyes on the prize and remember, it's the big picture that truly matters. Patience and a wide lens, that's your key to long-term gains. Moving on to tip number 5, stick to a philosophy. Now, what does this mean? It's all about having a clear investment approach and staying true to it. You could be a value investor, looking for undervalued stocks, or a growth investor, seeking companies poised for rapid expansion. Perhaps you're a dividend investor, focusing on firms with steady cash flow and generous payouts. Whatever your philosophy, it's vital to stick to it, to stay the course. Why is this important? Because changing your investment approach too frequently is like trying to chase the wind. You might find yourself constantly buying high and selling low, which is the exact opposite of what you want to do. It's like trying to jump between moving cars on a highway. Not only is it risky, it's also likely to get you nowhere fast. Your philosophy should guide your decisions, helping you navigate the vast, often turbulent ocean of investing. It's your lighthouse amidst the fog, your compass in unfamiliar territory. And remember, there's no one-size-fits-all strategy in investing. What matters is that your approach aligns with your goals, your risk tolerance, and your time horizon. In investing, consistency is more than just a virtue, it's a strategy. Tip number 6. Don't fear the small stocks. It's a common misconception that the larger, more established companies are the safer bet. But let's flip that script and talk about the potential of small-cap stocks. These are the stocks of companies with a smaller market capitalization. They might not be the talk of the town, but don't underestimate their potential. Historically, small-cap stocks have demonstrated a knack for outperforming their large-cap counterparts. It's like the story of David and Goliath, where the smaller, seemingly weaker contender surprises everyone with its strength. So give these underdogs a chance. Don't shy away from them just because they're not as big or as flashy as the others. Their growth potential could be just the opportunity you're looking for. Remember, big things often have small beginnings. Tip number 7. Don't be misled by low prices. Just like a clearance sale at your favorite store, low prices in the stock market can be tempting. However, it's crucial to remember that just because a stock is cheap doesn't mean it's a good deal. Low-priced stocks carry similar downside risks as their higher-priced counterparts. The risk is even more pronounced with penny stocks. These are stocks that trade for less than $5 a share and can be much riskier due to their potential for extreme volatility and price manipulation. So, even though a penny stock might seem like a bargain, it can quickly turn into a costly mistake. It's always essential to do your homework and understand the fundamentals of a company before investing, regardless of the stock price. In the stock market, low prices don't always mean low risk. Tip number 8. Don't ignore tax implications. Now, we all know that taxes can be a bit of a headache, but they're a crucial part of the investing equation. When you make a profit on your investments, there's a good chance you'll owe taxes on those gains. This is especially true for short-term investments, which are often taxed at a higher rate than long-term ones. But here's the catch. While it's important to be aware of the tax implications of your investments, they shouldn't be your driving force. Your primary goal should always be to maximize your returns. Think of taxes as a byproduct of successful investing. If you're making money, you'll need to pay taxes. But let's flip the script. If you're paying taxes, it means you're making money. So, don't be discouraged by the tax bill, it's just part of the journey to financial success. Remember, taxes are important, but they shouldn't steer your investment decisions. Tip number 9, invest for the future. Now this is where the real essence of investing comes into play. You see, investing isn't about looking backwards, it's about peering into the future. It's about understanding that the real value of an investment lies not in its past performance, but in its future potential. Why? Because the past, as they say, is history. What's done is done. But the future is a realm of infinite possibilities. So when you're evaluating an investment, don't get too caught up in what it's achieved so far. Instead, focus on where it has the potential to go. What is its growth trajectory? Does it have the capacity to innovate, to adapt, to thrive in the ever-evolving market landscape? These are the questions that really matter. Remember, the future is where you'll spend the rest of your life. Invest in it wisely. And finally, tip number 10, patience is key. Picture this, you're a gardener planting seeds. Now, you wouldn't dig them up every other day to see if they've sprouted, would you? Well, investing is much like gardening. The seeds of your investments need time to grow and bear fruit. Active trading may seem exciting, with all its quick decisions and potentially fast gains. But remember, it also involves greater risk. The roller coaster ride of buying and selling can lead to significant losses, if not managed carefully. On the other hand, long-term investing, much like our gardening analogy, requires patience. It's about understanding that the real growth happens over time, often years or even decades. It's this slow and steady approach that has historically shown to yield greater success. So, when you're tempted to react to the market's ups and downs, take a deep breath and remember your long-term goals. Stay patient, stay focused, and let your investments do the growing. Remember, in the world of investing, Patience isn't just a virtue, it's profitability. And there you have it, 10 essential tips for long-term investing. We began by understanding our investment goals, then we moved on to the importance of doing your own research and being realistic with expectations. We also stressed on the significance of keeping an eye on the big picture and sticking to your investment philosophy. We highlighted the potential of small stocks and cautioned against being misled by low prices. We reminded you not to ignore tax implications and emphasized the need to invest for the future. Lastly, we reiterated the importance of patience in your investing journey. Keep these tips in mind as you set forth on your investment journey. Remember, there's no one-size-fits-all approach in investing. It's a continuous learning process, and these tips can serve as your compass, guiding you towards informed decisions and long-term success. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel for more investing tips and advice. Let us know in the comments how you are planning to start your investing journey. Happy investing!